Whole life. Literally exactly how it sounds. With this type of life insurance, nothing about it changes. It never goes up or down, and some types of whole life policies don't really require any medical exams. One cool feature about these products is that they build cash value over time. So it's kind of like buying a house. You pay a premium and it stays with you for life, and it grows in value over time. Term life. Again, just like it sounds. Think about it like this: you're renting a home, you're promised a place to live as long as you pay rent, but only for a fixed amount of time. Same concept with term life. As long as you pay, you're covered typically for about 10, 20, sometimes 30-year period, and if you pass away, your family gets paid out. If not, and you outlive the term, well, nothing. It's just like when your lease is up. Universal life, commonly called a UL insurance policy. This type of policy is known for its flexibility, and what that means is that you're able to adjust benefits and the payments based on your needs. So just like a whole life policy, this type of policy gains cash value, but unlike a whole life policy, interest is earned on the cash value, which is pretty cool. This could be a drawback because the interest earned is tied to the market, so that's the only pullback on that. So while interest could go up, it's also likely that it could go down. Note, there are some companies that will offer protection against this. Guaranteed issue. Dare I say it again? It's just like it sounds. So with this type of policy, the rate of you getting approved is literally 100%. There's no medical exams, no medical questions, just a straight approval upon applying. The only downside to these types of policies is that there's usually a 2-year waiting period that comes with them, and it can typically be a higher premium for a lower payout. Variable life. Variable life insurance is another type of permanent insurance, but the difference is that it comes with an investment component. So they let you invest some of your premiums in stocks, bonds, or mutual funds. Now, variable life policies also build cash value, but since it's tied to the stock market, it's likely to fluctuate based on the investment you choose. So since this is a riskier asset, these policies allow you to move a portion of the premium to a fixed account to reduce the overall risk. Final expense. Very straightforward product. Its main purpose is to cover your death and any other debts that may have been left behind. This type of life insurance is to make sure that your family doesn't have to worry about covering any funeral costs when you pass away. Simplified issue. This type of insurance is a quick way to get insured if you don't want to take a medical exam and you don't want to wait months for an approval. The caveat to this is that it will typically be higher than the normal insurance coverage that requires a medical exam. And you'll still have to answer health questions, and there's no guarantee that you're going to get approved. Group life. This insurance is usually given by your employer. It covers everyone in the group, usually for free or at a very low cost. The only thing with this type of life insurance is that it might not be enough to fully insure you. And if you leave the company, the insurance doesn't go with you. Joint life. This insurance covers 2 people. It's usually best for couples. With this type of life insurance, there's 2 main types. There's first to die and second to die. For first to die, imagine both stick figures holding a heart. When one passes away, the policy pays out and the other person gets the money. On the other hand, with second to die, the policy only pays out after both people are gone. This is often used for estate planning, like leaving something for the kids or covering estate taxes. Mortgage life. This is a policy that's primarily focused on making sure your mortgage gets paid in the event that you pass away. As you pay down your mortgage, the amount the insurance will pay also goes down. Super simple. You're protecting your home and making sure your family doesn't have to worry about those payments if something happens to you. Credit life. This insurance is a safety net for your loans, like credit card loans, car loans, personal loans. If you pass away, it pays off your debt for you. So basically, the lender is the beneficiary. So instead of your family paying off your loans, the insurance does it for you. It's just peace of mind that your loved ones won't be stuck with your debt. Accidental death and dismemberment. Often called AD&D, this policy will pay you out if you die or get seriously injured in an accident, such as losing a limb, sight, or even your hearing. The only thing about this insurance is that it's super specific. It's only fully paid out if you actually pass away in an accident. If you're injured and you lose something like a limb, then you get a percentage of the payout based on the injury. Key person insurance. This is a special type of life insurance that a business takes out on its most important employees, like CEOs, founders, and top executives. How this works is if the key person passes away, the insurance company pays out the company, not the family. This helps cover the cost of finding a replacement or offsets the impact of losing someone vital to the business. Index whole life. This policy is like traditional whole life, but with a little bit of a twist. Your cash value grows based on the performance of a stock market index like the S&P 500. The good thing about these policies is that the cash value can grow when the market does well, but if the market drops, there's usually a minimum guaranteed rate, so you won't lose money.